Diane, Nvidia getting a boost perhaps after Meta a couple days ago said they're going to spend all this money. Amazon's going to invest heavily. Is it just sort of a read-through risk-on day for Nvidia?
Like that, and continuing the momentum that we saw yesterday, especially when it shows that the AI spending boom is not done yet. It still has legs, and that there is still investment there, the latest being Amazon and its need with regard to AWS, especially when you think about the capital expenditures that Amazon laid out. I mean, they spent nearly, nearly $25 billion, so that's up year-over-year basis more than 70%. They're on track to, spend massively this year, on track to spend $100 billion this year. And we know a lot of that with regard to Amazon helps Nvidia. It's largely to meet the demand for AI services via AWS. And so essentially what became clear was that Nvidia still plays a central role there, even though, they also have their own chips. But, they talked about the Nvidia powered chips backing them. And it's basically essentially a direct response to, the worries about flagging demand in this department. It reiterates the momentum that we saw with regard to Meta, Microsoft, that the chips need is still there, especially when you think about the AI arms race, which it seemed like it had been quieting down, especially in the context of the tariff conversation and the headwinds there. But now we've got the tone shifting to tailwinds for Nvidia, and you're seeing shares move, matching essentially almost the move that we saw yesterday.
Due to circumstances beyond the company's control, Nvidia's stock has been under pressure this year and has lost more than 19% of its value as of this video. This has damaged investor trust in the stock despite the company's strong last quarter performance. Nvidia has been underperforming in 2025 for a number of reasons, including export restrictions on shipments of its chips to other nations, the possible consequences of the tariff-fueled trade war, and worries that investments in AI infrastructure may slow down. Recent events, however, indicate that it is likely to continue growing at a healthy rate. In this video, we'll examine the elements that could help Nvidia surpass Wall Street's forecasts and cause the stock will skyrocket when it reports its first quarter fiscal 2026 results on May 28th. A significant portion of Nvidia's revenue comes from its data center business, which accounted for 88% of the company's top line in fiscal 2025, which ended on February 26th. Therefore, a major factor in determining Nvidia's financial performance is the state of this business. The good news is that recent quarterly results from its rivals in the semiconductor industry indicate that there is still a high demand for data center chips with an AI focus. In its first quarter 2025 results, Taiwan Semiconductor Manufacturing, also referred to as TSMC, stated in April that it anticipates double its income from AI chip sales this year. TSMC, the company that makes Nvidia's processors, notes that despite the uncertainties around tariffs, it hasn't noticed any changes in consumer behavior. Additionally, TSMC reaffirmed its $38 billion to $42 billion capital expenditure projection for 2025. The business notes that in order to meet the high demand for AI chips, it will devote 70% of that money to cutting-edge production technology. Additionally, it anticipates a modest acceleration of sales growth in the current quarter, which is encouraging for Nvidia as it is one of the biggest clients of the massive Taiwan-based foundry. Additionally, Lam Research, a supplier of equipment for semiconductor production, recently produced outstanding results that exceeded expectations. Strong guidance from the company, which was far ahead of projections, indicated that growth was improving due to the strong demand for AI processors. Furthermore, Lam projects that its top line would rise by about 63% over the next 4 years, indicating that it anticipates the positive demand to persist. Recent announcements from major cloud service providers suggest that worries about a possible decline in AI infrastructure spending may be exaggerated. For example, Alphabet claims to have been the first cloud service to offer the newest Blackwell processors from Nvidia. Additionally, as it seeks to strengthen its AI skills by investing in the newest gear, the parent company of Google has reiterated its $75 billion capital expenditure prediction for 2025, a 43% increase from the previous year. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Nvidia, now there have been all of these questions about demand from the hyperscalers, and some of that seems to have been erased this week, especially with what Meta said about CapEx. Microsoft, too. What does that do for your feelings about Nvidia stock ahead of its earnings coming up?
Well, I think that Nvidia is in a great spot. They right now there's a lot of doubt still. I do think that in order for the stock to break out, we got to get through these sectoral tariffs and AI diffusion. And then when folks know the rules of the road, the stock can really start to work again. That being said, I mean, it's the AI leader. If you accumulate the stock right now, I just don't expect overnight success like as much as last year when it doubled, more than doubled. But these guys are the leader. They're doing great. They have a new product cycle, and their big web scalers are spending. As I told you last week when I was on your show, watch Microsoft. They're the thing that is really, we got to watch. And they had a great quarter. They're going to spend big on cloud still, too. And then obviously Meta raised the CapEx, and Amazon has to spend as well to keep up. So, it was a pretty good week for NVIDIA, all things considered. But we got to get through some of that government regulation uncertainty, and then I think we can resume.
Ben, Julian Emanuel over at Evercore put out a note this morning, basically said, Tina turnaround here. There is no alternative stock trade, specifically talking about the mega cap tech stocks. And the fact that that was a trade that worked, and it worked through a number of things over these last couple of years, just to reverse here into the beginning of 2025. He's arguing that it's actually coming back around again and becoming a trade again. I wonder how you see it now that we are through so much of the tech earnings season.
Well, these companies are amazing and very resilient. So when things get uncertain, they can dip into a lot of different levers that companies just don't have. I mean, and the funny part now is that foreign exchange is becoming a big tailwind for a lot of our companies. Which is not the best, highest multiple thing you want, but even that is going in their direction. But these companies are very resilient, geographically diverse, and many of them are indispensable products that you can't live without. So, at these times of uncertainty, these kind of companies, definitely are things you want to turn to, in our opinion. And like I said, with NVIDIA, once we can get past some of this regulation, that'll start acting more, and asserting its leadership. But we got to get through.
Oracle has also begun implementing NVIDIA's Blackwell processors to power its cloud infrastructure and satisfy the increasing need for agentic AI and reasoning models. The organization plans to construct Oracle Cloud Infrastructure, OCI, superclusters with over 100,000 Blackwell graphics cards. The $500 billion Project Stargate, which is being directed by SoftBank and OpenAI, is also expected to yield significant rewards for the GPU leader. It is anticipated that NVIDIA will provide 400,000 of its AI chips for the initial Stargate data center. Its Blackwell B200 chip base variation costs between $30,000 and $40,000 per. So when the Stargate project grows to its maximum size of 10 AI data centers, it may see a significant increase in revenue. All things considered, it appears that the demand for Blackwell processors, which NVIDIA began selling in the fourth quarter of fiscal 2025, and which brought in $11 billion, will have a greater impact on the business when its results are announced on May 28th. For the first quarter of fiscal 2026, management has projected revenue of $43 billion, a 65% increase over the previous year. It may reach or even surpass its predictions, as seen by the increased manufacture of cutting-edge AI chips by its foundry partner TSMC and the rollout of Blackwell chips by significant cloud service providers. According to the reasons mentioned above, NVIDIA is prepared to deliver on all fronts, and an earnings beat combined with better-than-expected guidance may prove to be the much-needed impetus for the company's shares. Because it currently trades at an appealing 25 times forward earnings, purchasing this AI company before its next earnings report could prove to be a wise decision. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now, let's dive into today's video.
Diane, I get that, right? We're seeing some green on the screen here, but it seems like there's still some perceived risk out there for this company. Now, they report earnings on the last week of May here. What are still some of those risks out there that you are a little, maybe a little bit concerned about when it comes to NVIDIA or just the semiconductor space as a whole?
No, you make make a great point because, look, it got a rare sell rating this week. It got its first sell rating this week. And before that, essentially before you'd be hard pressed to find an analyst who was not bullish on the company. There is still largely bullish sentiment when it comes to Nvidia. So nearly 90% of analysts are still bullish and in the buy camp on Nvidia. You have fewer than a dozen who are in the hold camp, but you got that one sell rating this week. That was from Seaport Global Securities. They essentially see that the AI equation has been priced in for now. And they talked about the hyperscalers looking to design their own chips. And they expect AI budgets to slow in 2026. So that obviously stands, you contrast that with all the kind of bullish sentiment around it. And then obviously Nvidia has that exposure to China. That's a challenge. Now, we have seen some reporting from the information that they're working on the designs of the chips that they can sell there to deal with the, we know they already had tight export controls with regard to the chips that they can use there. But according to the information, they've been speaking with their customers, whether we're talking about the parent company of TikTok, that's ByteDance, or Alibaba, et cetera, about coming up with a new chip that can meet the export controls that the U.S. has.
Time will tell if that'll ultimately unfold that way or if it's going to be another one of the pieces on the global trade.
Due to its involvement in ChatGPT's artificial intelligence AI breakthrough, which established it as the clear leader in the AI accelerator market, the stock saw enormous profits in 2023 and 2024. Its products are so successful that almost all of its revenue now comes from AI accelerators. More recently, after the announcement of the DeepSeek breakthrough earlier this year, Nvidia retreated from all-time highs. The stock's near-term trajectory is further called into question by indications of declining demand and increasing competition. Is the stock a sell because of all these uncertainties? Let's examine it more closely. In the short run, Nvidia may appear to be a sell given its current situation. In addition to DeepSeek's innovation in reducing AI costs, new difficulties are appearing. One is political, since it may be prohibited from exporting certain of its goods to foreign nations by regulations enforced by the Trump government. Another is competitive, since a number of the company's biggest clients have investigated creating AI chips internally, which may be a bad indicator for the business. Furthermore, Nvidia's near-term prospects were called into question by the situation of Supermicro Computer, one of its most well-known clients. In response to what it refers to as delayed customer platform decisions, Supermicro, which incorporates Nvidia's AI accelerators into a large number of its servers, lowered its forecast. This is problematic for Nvidia because, in fiscal 2025, the data segment responsible for designing its AI accelerators generated $115 billion of the company's $130 billion in revenue. Although the business's revenue grew by 114% during the fiscal year, its sales forecast for the first quarter of 2026 would already indicate a slowdown to 65% growth, and the company would need to further reduce these projections if consumer demand declines. This could indicate that its 36 price-to-earnings ratio, PE, is not as good of a deal as it seems. Additionally, the price-to-book ratio of 33, which is significantly higher than the S&P 500 average of 4.8, may cause investors to reconsider the company's value. Investors, however, have strong reason to think that the pessimism is excessive despite its difficulties. The demand for AI is still enormous despite all of the issues. The market for AI chips is expected to expand at a compound annual growth rate, CAGR, of 29% through 2030, according to Grandview Research. Therefore, even though industrial growth is currently experiencing a brief disruption, it is probably going to continue and even pick up speed again as the uncertainty subsides. Furthermore, Nvidia continues to hold a commanding market share, especially when it comes to the most cutting-edge AI chips. Its market share is estimated to be 85%, which suggests that rivals are finding it difficult to compete with the business. Additionally, in order to compete, businesses must not only match Nvidia's Blackwell architecture, but also have a solution for its Rubin, a next-generation processor that it intends to introduce in 2026. Nvidia is expected to maintain its dominant position on the cutting edge, even if competitors catch up to its less sophisticated CPUs. In fact, since triple-digit increases are not long-term sustainable, revenue increases will decline. However, since growth is not expected to slow, net income can continue to rise quickly. As previously mentioned, its PE ratio is 36, and the projected ahead PE of 24 suggests that its profits will keep increasing. Even if some of the worst predictions regarding Nvidia's near-term future come true, The stock should eventually rise due to the forward PE being so cheap. The party is most certainly not over, and the stock is more likely to be a hold than a sell given Nvidia's current situation. Investors must, of course, prepare for a sharp slowdown in revenue growth. Even while the business and its investors have seen triple-digit growth in recent quarters, it is not realistic to think that Nvidia would ever sustain that pace of expansion over the long term. It's uncertain how quickly that growth will slow as more businesses halt their expenditures. In the long run, nevertheless, these worries are not likely to stop its development story. Over time, Nvidia should continue to provide disproportionate returns for its shareholders as the industry leader in the profitable AI sector. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
KG, what are we seeing into the close? I did see for a second there we started to sputter this rally, but maybe clutching at straws. I mean, we're up 92 in the ES.
Yeah, we did see actually a pretty decent drop here, but we're holding up towards the highs for the session here. Going into the close, we're obviously going to be focusing on that 5,700 level. If you estimate it out when you're looking at the volume flows just for the day's expiration for the S&P 500, you calculate out around an $85 billion gamma level, pretty much at that particular area there. So it's going to be a pretty hard area for us to be able to break higher. And if we do, Alex, I see 57.10 to the upside, not seeing that much more to the upside here for today. But what we want to be able to do is hold at least that 56.80 level. If we break below that, you start to look at around 56.70. And then that's where your negative area is. So that's where you want to be able to see maybe some buy flows really coming in. And if not, we see a little bit more of a flush below those levels, then obviously we have more to go to the downside here. But overall, you are seeing some bullish flow and activity here. I would say very notable what I've seen over the last maybe 20 minutes or so is a lot of upside call buying happening here for the next 2 weeks. Actually, 2 weeks out, saw about a $1.3 million trade when it comes to premium to the 58.50 calls to the upside here. 58.15 calls are also gaining a little bit of traction here. So you are seeing some bullish positioning, but that does not mean that hedge flows are not also coming in. Over the last maybe 10 minutes or so, you did see a lot of put activity taking place. Rightfully so, you have the weekend, you have some risk that is out there. And if you're just looking at the notational trades that have $1 million or up in premium here, Alex, it actually does skew more bearish than bullish, but that's okay because if it's hedge flows, and the overall sentiment is still to the upside here, we may be able to negate those. But we just have to be a little bit cautious here. Even though we've seen some really decent green on the screen, we'll look at some of the other technical levels here in a second to see why there could be maybe a potential risk for a small pullback in the market here.
Well, hedge flows just sounds like prudence to me after what's been 9 consecutive straight days to the upside, volatility normalizing quite a bit. Compared to where it had been. KG, you're going to be closing down the market with me at the closing bell panel. So I'm gonna put you on the spot here. As we're looking at these levels, do you think it's going to be a quiet next 25 minutes? Is it going to be a little bit of a melt up towards that 5,700? Or are we going to have one of those wild closes like we've been known to see in 2025?
Oh, that is a really good question. Okay, so I will say there's pen risk sitting at 5,700, and we always have to kind of acknowledge that. I would say that there is more risk to the downside here going into the close. The market on close orders themselves, if you do get a sell side print because of some of the aggressive buying that's taking place, as well as the unraveling speculative call flows, even and put selling flows from options traders that are especially trading 0DTE, I think there is a little bit more risk to us actually kind of losing maybe some of this ground. But I also have to acknowledge, Alex, that pen risk is sitting at 5,700. And I kind of look at pen risk first. And then if you do see any type of wacky adjustments, maybe a little bit of a pullback to the downside, but nothing too aggressive here. I think that we obviously will probably maintain gains for today. I would be very shocked if we got below even 57.70. I think that we probably still hold at 56.75 going into the close.
So 5,700, there's no debate. That's an important level. To the downside, I mean, take your pick, right? We got tons of places to watch. Where are we looking to the upside if this continues? You know, if we break through 57 and we go into next week, are we looking at the highs of mid-March, sort of that high 5,700, 5,800 level? Or do you got your sights set even higher than that?
I would look at 58 to 5,800 to 5830 to the upside. If you look at the daily chart, we still have a channel that is still going to be contested here to the upside here. That's why I say we're not out of the woods yet. We still have the 200-day moving average sitting at around 57.46, but you also have this blue line that we have on the daily chart for open interest here. We actually still have a pretty decent resistance level. Now, if we break above that, Alex, then, all bets are off. We're probably hitting all-time highs here soon. I'm not that optimistic yet. I would like to take it step by step when you're kind of looking at these levels and looking at some of these technicals. And if we actually kind of go to the weekly chart, I really want to kind of highlight this for the S&P 500 weekly. If you kind of look at where we are at right now, we are pretty much sitting at resistance at around that 50-month moving average here. Now, obviously, the last time that we've actually tested this and we saw a failure of this in a bear market type of cycle here was back in 2022. Was 2022 a little bit abnormal? It was, but actually it has more similarities to the environment that we're in right now more than anything, right? We had a situation where we had supply side shocks. We are kind of begging the Fed to really cut rates. We didn't have the justification to cut rates at that point in time. We kept putting off Fed rate cuts, and that's really what pulled us back here. Kind of a similar type of scenario. Last time that we saw this in 2022, we had from the lows at that time, from the lows to that 50-month moving average, was an 18% rally. Where are we sitting at right now? Around a 17.3% to 17.5% rally to the upside, hitting that same level. So I always go back and look at patterns in the past, and that pattern says, okay, this could be a potential level of resistance, really sitting at around this, sitting at around this 5698, 5700 level. And if we do see a pullback, you want to look at that 50% retracement level. Even looking at 5491 there is not really that bad. We're over the 50% retracement level right now. That's really good for the bulls. We're over the 61.8% retracement from high to low. That's really good for the bulls, but it is coming to an area of confluence, and we probably will see that 20-week moving average crossing below the 50-week moving average in the next 3 weeks or 4 weeks. That's not so much of a bear signal. Usually, actually, if you see that in these type of bear cycles, Alex, that tends to give you the signal that we are at the final stage of any type of bear trend within a cycle. MACD is looking pretty good. RSI has still not broken the downtrend yet, even though we're looking good off of these lows. I always look at the past and say, yeah, you could have these bull traps that are set in the market. And I think the only bull trap that we really have is, once again, the economic data over the next couple of weeks, as well as the Fed and Jerome Powell's commentary that we're going to have on Wednesday.
Kevin, normally I'm the one throwing the cold water on the rally, but I could just have Kevin Green on the show, and he's doing that job for me. But honestly, the end piece that you said sounds pretty optimistic. At this point, there's still risks. No one's denying that. Volatility is elevated, uncertainty is elevated, but it's been a nice recovery, and it's starting to look better by the day. KG.